back when Nixon closed the gold window, to acquire one of these babies would have cost you about $11,100. By the late 90s, to acquire one of these babies was $110,000. Today, at $2,700 gold, this is $1.1 million. This is the same bar. The gold hasn't changed. The purchasing power of the dollar has changed because now it takes 1.1 million of those greenbacks to buy this same thing. Current pricing scheme. This reveals to you the destruction of the purchasing power of the dollar and all fiat currency. I think you could even imply, Patrick, if we can both make it another 25 years, maybe this will be it'll cost you $11 million. Gold would be 35 to 350 to 2,700. This might cost $25,000, even 25 years from now.
The gold market has been experiencing some back and forth movement in recent sessions, with Monday bringing more of the same. The current levels suggest that investors may continue to buy on dips, reinforcing a trend of accumulating gold at slightly lower prices. A key level that's been in focus is $2,680, which previously acted as resistance and should now serve as solid support on any potential pullbacks. Amidst this technical backdrop, central banks around the world, particularly in Asia, have continued their aggressive buying of physical gold, marking a third consecutive year of record demand. This sustained interest, notably from developing countries like India and Turkey, has provided a strong foundation for gold's resilience. CraigHemke, a seasoned precious metals analyst and founder of the TF Metals Report, notes that central banks' ongoing purchases have significantly strengthened gold. As these economies shift away from traditional assets, their consistent accumulation helps stabilize prices and supports gold's upward trend. In addition to central bank demand, recent U.S. fiscal developments have stirred further interest in gold. The U.S. Treasury reported a staggering $380 billion deficit in August alone, a figure that has raised concerns over the country's financial stability. For context, the federal deficit from April to August reached $9.8 billion, compared to $4.3 billion during the same period last year, as reported by the Financial Post. Revenue did increase by $16.7 billion, or 9.3%, year over year, yet expenses far outpaced this growth, leading to a widening fiscal gap. This escalating deficit has caught the attention of investors, with many seeing gold as a hedge against potential economic instability. Hemke highlights that fiscal uncertainty and technical strength make gold an attractive investment. He points out that when gold prices drop, it creates opportunities for investors. With strong global economic factors and central bank purchases, the gold market is poised for gains amid ongoing uncertainties. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
When the year got underway, going all the way back to January, I thought, by the time we get around to the Fed actually cutting rates, we'll probably have gone sideways for about the first 6 months of the year, and then we'll finally break out. We'll go to about 2,300, and that's maybe about the best we could expect, because as we entered the year, the talk was, the Fed's going to cut 6 or 7 times, and the dollar index was down around 100, and had you known then that those rate cut expectations were going to get trimmed back to basically zero by June or July, that the yield on the 10-year note was going to go up 50 basis points, that the dollar index was going to go up by 5 or 6%, you'd have thought, oh man, boy, we're in for a tough start to the year. And instead, gold takes off. And I'm first to admit, I was pleasantly surprised by that. Once it actually broke out of its 3.5-year range back on March the 1st, it was just off to the races. And then eventually the attention turned to silver, and why isn't silver moving to catch up? And then silver moved to catch up. Gold then goes sideways through the summertime, then breaks out again. And so we've been waiting for silver to break out again. Now that has happened as well. So it's been a very exciting year. What I think central bank gold demand is obviously a big driver, because this is going to be the 3rd year in a row of record central bank demand for physical gold. And you can certainly see this across, whatever you want to call it, the developing nations, the BRICS, the global south, whatever. You can definitely see every month, India, Turkey, just go down the list, are constantly adding gold. But I think we're starting now to get enough headlines, that people are paying attention to gold in the first, that, wow, look at that gold go. I wonder what's going on. Then you get news like the fiscal situation here in the U.S., Patrick. And I think this was an underappreciated moment about 6 weeks ago. The U.S. Treasury Department is supposed to, at least, on the 8th business day of every month, report the previous month's deficit numbers or surplus numbers, or how much income they took in through taxes and fees and how much they spent. Okay, 8th day of every month that's supposed to come out, 8th business day. Well, that turned out to be for the month of August. That was like September the 9th or 10th or something like that. And that day, the U.S. government reported that for the month of August alone, the fiscal deficit was $380 billion. And hell, for me, it was like, what? In a month? $380 billion? And I think that kind of, if you're a fiduciary managing retail money, hedge fund money, whatever, that was kind of a shaky by the lapels moment. Like, wait a second, this is really getting out of control. And gold has moved up about $150, $200 since then. And I think, so I kind of got this combination of factors that just keeps putting a bid under gold and keeps moving higher without a sustained pullback. The fiscal year in the U.S. runs October 1st to September 30th. So we just finished fiscal year 2024. And the total annual deficit, added all the 12 months together, was $1.83 trillion.
The gold market remains well supported by safe haven demand, with investors closely watching the upcoming release of key U.S. economic data, including the Labor Department's October employment report. Adding to the market's focus is the uncertainty surrounding the upcoming U.S. presidential election, which has heightened investor interest in protective assets like gold. According to precious metals analyst CraigHemke, the pace of gold's rise is under scrutiny. While some analysts forecast a dramatic increase to $3,000 or $4,000 per ounce by year-end, Hemke notes that, given the current pricing structure, such rapid gains are unlikely. Gold's movement tends to be steady and gradual, rarely showing sharp overnight surges due to market resistance. From a technical perspective, December gold futures remain in a strong near-term position, with bulls maintaining a clear advantage. The next key target for gold bulls is to secure a close above $2,800, a solid resistance level. This would mark a significant move and signal further strength in gold, bolstered by ongoing demand and economic uncertainties. Let's get back to the interview.
The pace is the question a lot of times. I see these things too. 3,000, 4,000 could be there by the end of the year, all this kind of stuff. Under the current pricing scheme, that's not typically how things unravel, right? It's almost always 2 steps forward, 1 step back. That's what we're seeing now, just a series of higher highs and higher lows. What there hasn't been is a big washout pullback that has allowed the banks to kind of flatten their books ahead of the next rally. They've just had to accumulate shorts and just keep shorting and supplying liquidity by taking the short side, against new long demand from hedge funds and the like. But as long as we're under this pricing structure, you're not going to wake up overnight and see, these $100 and $200 moves, because the banks are going to fight that, at least they always have. I would assume they will as long as they can. So that's one part of that equation. The other part, too, is, people say all the time, well, if the metals have been manipulated by these banks for profit over all these years, how come the price goes up? Well, because you can manage that. Like I said, in this process of higher highs and higher lows, they can manage that effectively. Gold can go up 10% a year on average. And these bullion bank trading desks, they're still profiting. They're still in business. Again, these are bankers we're talking about. If the precious metals trading desk was losing money year over year, they just shut that shit down and, but they're obviously making money at it even when price is rising. I think the problem, I've always said, is the 30% years, the 40% years. That, to me, always seemed like that was more difficult to manage. And that's the kind of year we're having this year. And so, does it get away from them? That's ultimately a question. I guess the next thing that's on my mind, Patrick, and I've been using this prop. I have a prop for you. You like that? Can I bring in a prop?
Yeah, of course.
Even under this pricing scheme, okay? Nixon closed the gold window in 1971. Americans were allowed to own physical gold again on January 1st, 1975. The COMEX, coincidentally, began trading gold futures on December 31st, 1974. That's an interesting coincidence, isn't it? But anyway, even under this price discovery scheme, gold has gone from 35, 42, up to 200, up to 800, back to 200, right?
Mm-hmm.
Here's the thing. As I reach forward, you get a good look at my face. So I have this, right? Look at this. Ooh, Craig's got himself a 400-ounce bar. No, actually, it's just a piggy bank. Okay, so Nobody needs to break into my house and think that I've got, but okay, but this is the form that most people have seen, right? Mm-hmm. Okay. That's a London, they call that a London good delivery bar. So in London, the standard is these 400-ounce bars that they stack, on a pallet, and you see them. Okay. So back when Nixon closed the gold window, to acquire one of these babies would have cost you about $11,100. By the late 90s, to acquire one of these babies was $110,000. Today, at $2,700 gold, this is $1.1 million. This is the same bar. The gold hasn't changed, okay? The purchasing power of the dollar has changed because now it takes 1.1 million of those greenbacks to buy this same thing.
With central banks' strong interest and mounting fiscal concerns in the U.S., gold has secured a solid position as a hedge against economic instability. The consistent support from developing economies and the appeal of gold during uncertain times suggest that any pullbacks could present valuable buying opportunities. As global financial landscapes shift, gold's steady demand growth continues to highlight its role as a protective asset, particularly as it hovers near significant technical levels. How do you see the balance of technical support and global economic pressures shaping gold's price trajectory in the coming months? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.